Hey, greetings. Jeffrey Scott here. This is my Market MRI Pro update for Thursday, November 6, 2025. I just put the title of Market Heading Towards the 50-Day SMA, and will free parking, which is what we call it, will it hold? And it is a natural place to return to. It's a natural place to see the market hold, but we're really not, in my opinion, seeing signs of capitulation. And despite what has been a pretty significant drop in the US market so far this week, um, one of my favorite websites that shall remain nameless is still saying to have 60 to 80% exposure, which I think might be aggressive. Let's take a look what we see and see what we think. MarketMRIPro@gmail.com is my email address. My Google group is Top Down Trader. Please feel free to join. Love to have you. You'll get some discounts on my tools. And once in a while, I just communicate to them without a video because my wife gets mad at me sometimes when I make noise when we're in a hotel room. And email, or excuse me, website's marketmripro.com. And I've been married 40 years, and one thing I've learned is you obey the wife. This session's for educational purposes only. Anything we talk about is in the spirit of education, should never be considered investment advice. I do these videos for a couple of reasons. One is to help you, is to show you how I use the tools to do top-down analysis. And the second is it forces me to follow the same pattern. And although I've got a lot of discipline after 3 decades of being in the markets, it forces me to have some accountability. Trading involves risk. You and your alone are solely responsible for any investment decisions you make. I may own or intend to buy or sell any stock I mention in this report. Trading stocks and options should be considered risky. You should consult with your financial advisor. And I've got tools for multiple platforms. I'm independent. I'm getting excited because we're soon going to launch the Metastock plugin. My Google group I mentioned is called Top Down Trader. Just go to Google Groups, sign in, look for Top Down Trader. Let us know how you want to be contacted, and we welcome you to join the group. News and earnings. So Friday would have been a big day with the monthly employment report, but we're not going to get those because the federal government still shut down. We likely will see consumer sentiment and credit, and you know the credit's backwards looking. September sentiment is current. If sentiment comes in weak, we've gotten some weak jobs numbers. I'm beginning to wonder if we aren't already in a depression, excuse me, recession, not depression, recession. And is the Fed going to soon be playing catch up? Um, if you listen to Powell, I'm sure you all did, Powell was sort of saying no guarantee of a rate cut in December. I don't know if I believe him. If you look at earnings on Fridays, you got Wendy's, you got Constellation Energy, one of the CEG, one of the companies that's in data center power, Fluor, a big construction company, Duke Energy. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Should we be concerned by a cluster? I've been asking that for the last week, and I show you that the big drops occurred after sort of a cluster. Well, folks, we've had 6 Hindenburg Omen signals on the NYSE in the last 7 days, the trading days. And then you should have changed the title. Last week, they recouped some of the losses from the prior day. This would have been yesterday's. And today, they actually finished inside of the body of yesterday. So they were down a little bit, but they recouped some of the early losses. In fact, they actually traded down to their 17 and bounced. For more information about anything I talk about, how I trade, my educational programs, um, anything I mentioned, just email me at marketmripro@gmail.com. And if you have questions about using the program, we know that Avast antivirus is causing issues with installation. Well, it's not because we're a virus. It's because we're a small company. We got a new product and we don't have years of experience and tens of thousands of users. So a lot of the antiviral looks into their data set, historical data set. They don't see us and therefore they flag us. We're porting it to the Windows Store, which will alleviate all those issues. And those that are current owners will be getting an email probably in the next week, if not sooner, from Praveen of how to port to the Windows Store. and also as helpful on the updates. Let's go take a look at the charts. So another day, more losses. You can see volatility was up another 3.95. Dollar was up, excuse me, dollar was down 0.5%. Diamonds 0.81, Spider a little bit over 1, 1.77 down in the Russell, and 1.87 on the Qs. And Bitcoin, which is in a bit of a crash, was down another 2.82%. In many ways, Bitcoin seems to be getting to that point of capitulation where you might expect reversals. I just don't feel that the markets are there yet. You look at the Russell, it finished 7% off the low of, off the bottom of the daily range. If you look at new highs and new lows, at left is the NYSE, right is the NASDAQ. I look at 52 weeks, they both turn negative net, and you could see we're now triple digits on the new lows on both of them. Bull markets are not built upon new lows, they're built on new highs, and we have less and less new highs. Another thing that bull markets are built upon is increasing participation. We've been hearing about bad breath on good days. Well, you get bad breath on bad days. You can see here only 23% of the NASDAQ were up, 28% of the S&P 1500, and 31% of the NYSE. As much as Wednesday was a strong day, Thursday was at least equally to the downside. What worked, according to the S&P 500 sectors? Energy, which is volatile and has a life of its own, but healthcare, which is sort of defensive, held up well. Um, what didn't work, another day where discretionary is down 2.31 and now flat over the last 20 days or month. Technology was down 2%, now negative over the last month. And communications was down 1.68, now minus 2.19 over the last month. 20 days is about a month's worth of time. Those are pretty negative. What was working today? Oil, gas, copper, silver, Southeast Asia, China, renewables, MLPs, China, metals and mining. What really was underperforming? Marijuana, uranium, blockchain, fintech, retail, robots, millennials, semiconductors, software, solar, and clean tech were all down over 2%. Clearly, rotation out of what has been leading. Was this a one-day wonder, or are we now seeing the various industries and sectors break down as the market's sell-off continues? Let's look at the timing model. I think what you're going to see here on the weekly, these are pretty bearish looking weekly candles. But two things have to happen before the weekly model turns to a sell. The bongos have to go from blue to red, and we got to close below this WMA. The dailies, well, different story. Where everything's green on the weekly, everything is now turned red on the dailies. So we now have a four market sell on the dailies. Our more intermediate or longer term weeklies are still in a buy. We still would be in what I categorize as a pullback in an uptrend. Uptrend still intact until we probably start taking out these lower lows in here. And we had a higher high on the last swing. So the uptrend is still intact. At some point, when those weeklies start to go to a sell, I'll start thinking that it's more a pullback and leading to a larger pullback and not a pullback in an uptrend. But I don't think I can say that just yet. So dailies clearly below the WMA. And except for the diamonds, which is barely negative, some of these may take a while to flip back to positive. If we look at the US index ETFs, I mean, the theme today is, will we run to the 50 and how long is it going to take and will it bounce? We are clearly heading this way. Now, is it going to be as obvious as this was with a touchdown here and then a bounce to new highs? That would be okay, and that might be what we should anticipate. Are we going to say great seasonality and we're just going to go higher from here? I think that's possible as well. I'm going to wait and see because right now this is just a flag after a big uptrend. but I think it's a flag that may have broken down through the bottom and is going lower. That's my take on the spiders. Not a time to be adding to your longs. In fact, probably be reducing them. Q's similar is that we closed today at upper left says 611.67 and the 50 is at 669. It's 2% away. I mean, that's another day and a half, or maybe it comes on Friday. I'm not sure if that's not inevitable. Now, it will be beautiful if we pull back and then we trade higher. And that has to be my anticipation. I don't see us going into a big bear now. I don't think I mean, I have concerns about whether or not we're stepping into recessionary times and the Fed's behind as they always are. But unless we have a recession, I think we're probably going to bounce. But how do I know? I'm going to look for capitulation. I'm going to look for other signals. And just because I think we may bounce at the 50, I'm not putting in buys based upon that. I'm going to look for the weight of the evidence to help me decide what I'm going to do. Nothing's going to look different on the diamonds. It's the same story. We're pulling back in an uptrend. So the diamonds, for example, the close was at 649.28. The 50s at, excuse me, it's 469.28, 463.89. It's 1.5% away. I think it's inevitable. Why do we call the 50 free parking? Because it's a great place to take a rest before you continue higher. So would not be, in my opinion, the end of the world. Looking at the Russell, it broke the 50. That's problematic because one could argue that that was one line of support. Maybe there's a line here at about 217, and we currently are at 240. No, excuse me, 237. So that's only a little bit less than 1%. But I think there's risk of a bigger breakdown here. Look underneath. You've got um, coming out of a squeeze and going down. You've got negative, you have volume to the downside, momentum, breakout to the downside. I think there's risk here. This one looks different because it's blown right through. Now, um, this here was a big bearish candle. And I think as long as this bottom holds, we're okay. But if we break through this line, I think it's time for me to start thinking about playing to the short side. And I'm already think it's time to start nibbling there, or certainly to lighten up your longs. Volatility up again in the market. Now it's wishy-washy. It was up 8%, which to me is bearish because it's not at the point where it's obviously reversed because it's run its course. I mean, when you see this bar, I mean, you know it's time to buy. And no shocker, what was the date? The date of my buy signal, my buy video, April 7th. I see a market that looks like VIX is going higher. VIX goes higher, markets go lower. And then the dollar, which had been in a multi-day rally, but as we talked about, not when you look at where it came from, actually had a pretty significant pullback today, down 0.5%. So that's heat is perhaps taken off the market. So, I mean, if I had to predict from here, and I'm not in the prediction business, I'm in the reaction to what happens business, but I like to be prepared. I think we pull back to the 50 and there's a good chance we bounce. Commodities, but I won't play a bounce until it occurs. I'm not going to expect a bounce. Now, you could see both gold and silver are way off their all-time highs and sort of consolidating above the 50. Oil dropped a little bit today. Natural gas is inching its way higher. I actually bought one position today. I closed a couple, and I'm surprised I bought something, but I had put a buy order in on Expand Energy, which is the old Chesapeake, because of its marching higher, and I got filled. So I actually have a energy play that produces natural gas. And the story's all got to be about Europe bailing on Russian gas earlier than expected, the expansion of liquid LNG, and it will drive a bigger market, which will drive higher prices. 10-year and 30-year both came back down some in the market, down 1.7 and 1.1 respectively. No surprise, concerns about the economy leads to a market sell-off, and the rates come down with it. If we look at the buckets, again, we've got 16% of stocks below the Bollinger Bands on the NYSE. We have 21 on the NASDAQ. We've got 21 on the Russell, and we got 17% below in the S&P 1500. When you consider the fact that stocks are supposed to live within the bands 90 to 95% of the time, when you start to see 10, 20, 30, 40, 50% of an index trading above or below, you get to a point where soon you're going to expect a reversion to the mean, which means the market to bounce. We're not there yet. It could bounce tomorrow. We're not there yet, according to the buckets. We could get significantly worse. How bad can it get? Remember that you know what my favorite date was this year? April 7th. I made a call. What did it look like on April 7th? A whole lot worse than it looks right now. You'll see 76% below, 80 below, 66 and 52. Thank God we're nowhere near those numbers right now. But and I hope we don't get there, but I am nervous about this market, and I think we have a higher chance of going down than being done going down. Part of why I'm nervous, you could see that the NYSE has clearly broken below the 50. It's failed 1, 2, 3 retests, and it looks like it's going lower. The NYSE has not hit the 50 yet, but boy, it looks like it's got every intention of coming down and testing. When we look here, we can see the number of new high, new lows are, the number of stocks above the various moving averages are coming down. Over here, it looks bad until you do this and look at more data, and you can see we're not at a point where you expect a reversal on either of them. Come down, but not enough. And then you look below, you can see that the up-down volume, the AD lines, the new high, new lows, the up-down volume, the AD lines are all negative. So pretty bad day for breadth. I think when you saw 20 to 30% of the stocks were up, tells you how bad of a market day it actually was. And here again is that cluster of Hindenburg Omens. We saw this earlier cluster, and we had a sell-off. This reminds me of sort of a double top, but more days between it in 2007, which is right before the great financial recession, and the markets had a big dive from here. I'm concerned. I think that should be obvious in everything that I'm saying. Market breadth, number 2, I'm looking for 13-week new high, new lows to get down to 0 or 1%, or 0 or 0.1. We're still at 0.32, 0.21, 0.28, 0.34. What does that tell me? We're not bad enough to expect a reversal tomorrow. We could get one, I just don't expect it. The AD lines here are heading down on each of the indexes. This is the spider. This is the NASDAQ Composite, the Russell 2000, and the S&P 1500. And the AD lines and RSIs are all heading down. I don't see anything here that suggests to me that the market's ready to bottom and go higher. It could happen tomorrow, but I don't see it here right now. It doesn't mean it's got to wait for my permission. What else can I say about this? I know a lot of people are wondering how come they don't have this. I just want to show you the 4 or 5 steps it takes to build it. So remember, I've got the spider, the NASDAQ, S&P 1500, and the Russell. You're going to go to the little plus. You are going to call this, and I already got market breadth 2. I'll just call it market breadth 2. You want to have 4 boxes. So you don't want a screener. You want 4 boxes, not 4 columns, although you could do it either way. You want to sync them on the interval and the date range, and you hit create layout. This is how we've designed it to be relatively easy for you to develop new layouts. So now I should have 4. Okay, here's the spider. Here I want NASDAQ, so IXIC. There it is, NASDAQ. Over here I want it to be SPTM, which is the S&P 1500. And then over here I want it to be the Russell 2000. All right, now how do I put all those indicators? Well, if you go up here, and I validated it on another user's computer yesterday that it's already set up, this is how you copy a layout. So for the spider, I want expanded market breadth spider. There it is. I hit yes. And voila, it should open up with the various indicators. And of course, I messed up because I didn't highlight the spider. So that was a teaching event of me. Spider's highlighted. Now I'm going to do the spider. You have to highlight it and drop the correct one. So you could see this is the S&P. It's not the Russell. So I'm going to go back down here, go up here and find the Russell one. Up in the upper right-hand corner, we got the NASDAQ composite. So I'm going to find the expanded market breadth of the NASDAQ composite. And then down the left, I've got the S&P 1500. I'm going to highlight it, open this up, find this, click it, say yes. So it'll take a second probably to load the last two, but literally in 30 seconds, you have built for your own pleasure my second market breadth. And what does it have in it? The green line is my favorite 13-week new high, new low, a very fast reversal indicator, but it's got to get down low. What did it get back here in April? Got down to 0.02, 0.01 on the S&P 1500, 0.02 on the NASDAQ, and 0.01 on the Russell 2000. Although it still says, yeah, it's R2K. So I think that this is a very useful tool. Now I see something that's not right, I think. Let me just check. I want to make sure that this green one is actually the Russell. So I'm going to open up the gear and I'm going to look at this up here and it says it's the Russell. So it is the Russell. Okay, good. All right, that's all you got to do to create it. I don't need 2 of them. And I'm just going to kill it. I'm going to highlight it here, hit delete layout, and it's going to go away. All right. So we've looked at the markets. Let's take a look at the ratio charts very quickly. And the ratio charts show me that little life in financials today. Tech continues to roll over. Defensive things like energy, staples, healthcare looks great. Utilities, real estate. We're rotating into the defensive plays. Is that because they're good, or is it because the rest of the market is not and that's defensive and moving out of growth? I think that's probably what it is. Now, a lot of people ask, well, why don't I just look at the regular ETFs? And you could do that, but by looking at a ratio chart, both divided by the spiders, it mitigates a lot of differences. And it shows you which ones are outperforming the S&P and which are under. So I did create a new one called, hold on, I've got a different new one, this one here. And so we've got each of the S&P 500 sectors, and you could see which ones are in a buy right now. Let me give you less days. Let's just go down to 30 days or 30 bars. So who's in a buy? This one's in a buy, which is energy. That was leading today. Healthcare has been in a buy for some time. That's it. That's it on the buys. We lost technology and discretionary today. So there is a lot of weakness in this market. So, summary, be careful. I have used the last week to take more things off the market I have put protection. Um, you know, I hung out with the user who's down here today and talked about our Celsius trade. I bought Celsius at about 60. Um, it ran very quickly to 65. I don't trust anything in this market. I sold a 65 call, bought a 64 put. Fast forward a couple weeks, market earnings came out today and Celsius is 43. I'm so happy that on next Friday, if I don't do something before then, I get to sell my Celsius for 64 bucks anyways. I have put protection on the majority of what's left. I am way over 50% in cash. Doesn't mean you need to be. Doesn't mean I'm right, but I'm doing money management. I am protecting my gains. I'm protecting my bank book. And if I lose a few percent, if we rally back and retest before we fail, so be it. I can get in the market immediately, as can most of you. If you're a hedge fund manager, money manager, and you have $500 million under assets, 5 billion under assets, you might not be able to move as quickly. We can move quickly. That's the power of the individual investor. So why not be careful? So if it comes to looking at stocks today, we're going to cut this short. Um, I got to reboot that. Sometimes when I start a new, uh, I lose that. And Praveen, when you see that, that's what I mentioned to you that we got to figure out why and fix it. Um, when I reboot, they'll be there, so I'm not really worried about it. And I know we've got a new version coming out for those of us on the Windows Store tonight. And again, this will come out to most of you. And the beauty of the Windows Store is once you've installed it, and we'll send you links and all the things that you need to do. All you got to do in the Windows Store is you go to check for updates, and it will check all your applications for updates, and it will automatically update them for you. I believe there's a way to automate that so you don't even have to go check, but that will make our lives, I think, significantly easier. That's the only thing to be updated. So let's just let it update. So we don't have an update yet. Um, I'm only going to look at two things. I'm going to look at the A and A pluses, and we'll start with the A pluses. And if I needed to buy something tomorrow because I can't help myself, I might look at VET, which is a low cost energy play. Why would I look at it? Clearly, it's been in a longer term downtrend. But if you look at it over the more shorter period of time, it's been an uptrend off the bottom. What's different today? We had a breakout above the 200 and the 50, massive volume. We had it up here and it didn't hold, so I'd be careful. But we had a gap volume breakout momentum out of a squeeze. Relative strength and OBV look good. Um, I wouldn't be against a small position in an energy play. As I mentioned, I did buy into um, this one and I got filled, and we'll see if it goes anywhere. It's mostly a natural gas. Um, I wanted to buy this today, but I did when the market was down. I decided not to push my offer up, and I think it's okay because if you look at what happened, I would have potentially filled here. It got up there for a microsecond, but I'm going to leave it on my buy watch. I just looked at Marriott coming out of a prolonged sideways move. Now I just ruined it by moving that. Um, and so I thought that one looked interesting. And I also wanted to adjust this thing down some. Oh, why are you doing that to me? Of course, when I not have people watching and talking to them, it's much easier. So it broke out of a Darvis box sideways move. I still like it. Look at the seasonality. Today, that was on the list. On one of them, I think was Hilton, HLT. Is this the one? Is it this one? Not as good as the Marriott, hasn't cleared the 50, but another thing was strong seasonality. So I liked the Marriott still. And then in the healthcare space, I like healthcare REITs. I sold my practice a long time ago. Before I had sold my practice, we built a number of offices. Then we decided we got nervous and we got tired of being landlords. And we got nervous that our business and our livelihood was tied up in the same thing that was probably our biggest debt instrument. And the good news about being your own tenant is you're probably not going to get kicked out of your building. The bad news about being your own tenant, if your business goes under, you're still left holding the building. So we sold it to a REIT. And but how many medical practices, hospital systems have you seen go out of business in your lifetime? Not many. A lot of them get acquired, and that's okay because typically if they have debt tied to a building or something, that's all addressed in the takeout. Here's Sabra. Sabra is a medical REIT, pulled down to the 200, bounced around, and then it had a pretty big move today. Now, seasonality doesn't look anything, it's sideways, but you had a very big up bar, 3% up, a couple days in a row of massive volume. Look at this wall of blue dots that have come into the trade. Look at the relative strength in the OBV showing some strength. And then if you look up here, you can see earnings are already out, which is great. And it pays a 6.9% dividend. So I like this. If I had to buy something, I'd buy something safe. I might buy Sabra. On the A plus scan, I looked at it and frankly, I saw more things I liked on the A's. And just to look back very quickly, Ambarilla looked interesting, but it's a tech stock. But look at this, it's relatively tight. It's in a beautiful uptrend. I checked, earnings don't come out to Thanksgiving time. So I don't know why it was up today. I looked at the news. Somebody bought a bunch of it. Hot momentum stock for the long term. Well, that's a pretty strong comment. That's a month old. They had their first big run, and this is pretty neat, I think. I participated in this one, and one of these was called GoPro. Maybe this was the GoPro. Yeah, this was the GoPro rally. And then the stock died. And then it did it again. And then it died. Is it getting ready to repeat and do it again? Maybe. But that's a beautiful tight chart. Sideways move into the 50 and a breakout. I love that pattern. Um, I'm not telling you to go out and buy long stuff. That's why that's it. So, summary, be careful, be careful, be careful. Look for signs of capitulation and a bottom. What will you expect to see? What I would like to look at is this market breadth. I would like to load up, see some big volume on a down day. I'd like to see a Phoenix come in telling me that we're getting washed out, a couple of bingos. And then I want to see our magic signal, which shockingly fired 2 days after I said buy them, it's time to go long. This is called the CPR, or excuse me, the defibrillator signal. And it's really good at finding big bottoms. And you don't see it very often. You only see it at bottoms. So I'm going to look for some of these things to come in. Right now, I see a weak market that has no signs underneath here that says it's done going down. Have a good weekend. We'll post something on Friday night or Saturday.